Hello everyone and welcome back to the latest BKL webinar. My name's Anthony Newgrosh. Thank you very much for joining us and a happy new year to you all. So Christmas came and went and sadly we're all back in lockdown. We hope you're all, most importantly, keeping safe and well. And as if it couldn't get any worse, it's now the self-assessment season. So I'm delighted to be joined by two of my erstwhile colleagues. We've got Geraint Jones, Head of Private Client here at BKL. Hi Geraint.
Hi there.
And Chris Smith, who heads up our personal tax team. So welcome, Chris.
Thank you. Good afternoon, everyone.
So we're here to have a little fireside chat about sensible, pragmatic, pre-year-end tax planning that you can all have a look at. Nothing too aggressive here, but just sensible, solid ideas that might just save you an awful lot of tax and save your clients an awful lot of tax. So let's see what we can do in the next hour for you. As always, we do welcome your questions. So on, I think, the right-hand side of your screen, do feel free to type away. As time permits, we'll try and answer those. If not, we will keep a log of them, and if we can come back to you after the event, we will. And we'll also send you both a copy of this recording, so you can listen to it again if you so desire, or we'll send you a copy of the slides as well as a point of reference. So we do look forward to hearing from you on all of that. We, like you, we're all working from home, so let's hope the old broadband keeps up. If not, we've got David, our producer, in the background, who will manfully step into the breach, I'm sure. So thank you, David, for all of your help. So without further ado, I think, Geraint, you're going to lead us off. If you'd be so kind, let's start by talking about making use of tax allowances, and there's far more here than there used to be, isn't there? So Geraint, over to you, if I may.
Thank you very much, Tony. Well, as you can see, there are far more allowances knocking around now than there were when I first started doing personal tax. And it sounds very obvious, but not everyone makes use of all these allowances. So a key piece of basic planning is to ensure that all your allowances are used up each year. Now, you can do that in a number of ways, arranging for personal investments to be spread across you and your spouse in a tax efficient way to make sure you both use up personal allowances. If you're an owner-managed business, you can ensure that you're voting dividends out to ensure that the tax-free dividend allowance is fully utilised and that personal allowances for you and your family are all fully utilised. Another possibility is, and people often overlook this, is the use of children's and grandchildren's personal allowances. I mean, you can use those maybe if they're beneficiaries of trusts. You can arrange for there to be a trust distribution to use up their personal allowances. That can also lead to a tax repayment based on the income that they receive from the trust and the trust tax credit. So that can be an interesting piece of planning one can do. There are capital gains.
Just jumping in very quickly on you. With one point, I just also thinking about the planning on the personal allowances side for grandchildren. We haven't put it in the slides, but we're trying to keep this quite basic. But I do recall going back a year or so, I think we put some planning in place. And it's very much whether somebody's got the opportunity to do this, and it's really whether you're an individual that's trading, has a business, and has got grandparents or your parents still alive. And the whole idea is ultimately getting grandparents' shares to put into a trust and then passing on to the grandchildren. And this very much goes back to the personal allowance side. We tend to think it's just us that have personal allowances, but of course, children, minor children, all have the allowances as well. So there's opportunities there. I think there's no point really going into great detail on that specific, but the general point is, don't think it's just your allowances. Certainly where we see the individual we put it in place for had 4 children, and that's quite an extraction of funds utilising.
We should also add there is, suffice to say, copious amounts of anti-avoidance where you start trying to divert income, particularly to spouses or to minor children. That's perhaps for another day, Geraint, but the principle is there, isn't it? We should certainly try and make the use of all of these allowances.
Oh, absolutely, absolutely. And I mean, there are capital gains tax allowances that one would need to take account for. Now, there, as you'll all be aware, there is anti-avoidance legislation out there to stop people doing what's called bed and breakfasting, which was the practice of selling sufficient shares to use up your annual capital gains tax allowance prior to the 5th of April, and then repurchasing the shares shortly thereafter. Well, for some reason, Gordon Brown got very upset about that and introduced an anti-avoidance piece of legislation saying that you would match any subsequent purchase within 30 days with the previous disposal. But you can still do a number of things around that, and we will go into that in a little bit more detail a bit later on. But floating around on this subject, there's another issue. You will not, some of you may well have seen the Office for Tax Simplification report that came out in November, in which various ideas were floated, some of which were more aggressive than others. And one of which was that the capital gains tax allowance should be halved, because there was a theory that it wasn't really there to allow multi-millionaires to get a large personal exemption, but it was more there to stop people who have a few shares in the company that they work for not ending up with a capital gains tax liability or disclosure requirements should they choose to sell them. So one of the proposals was that the annual exemption of, I think, 12,300 would be halved to 6,150. Now, the government distanced itself somewhat from the report, and the report was rather more nuanced than the media gave the impression of. But these are other issues that one might bear in mind, that there could be reductions in the annual exemption coming up. So one might make a decision as to whether one wants to make preemptive action before the 3rd of March, which is the date slated for the budget, rather than kind of cross your fingers and hope that Rishi Sunak's not going to increase taxes at a time when the economy is heavily deflated by the COVID crisis.
Indeed, and we'll come back to CGT planning a little bit later in this talk. But should we move on, Geraint, and talk about where we are as far as tax bands, etc. go? If I can advance the slides. Oh, wrong way. Sorry. There you go.
Marvelous. Right. You'll all be very familiar with these slides. There was an item in the notes to the autumn statement saying that most of the allowances would be increased by 0.5%, which was the CPI in September for 2021-22. So we can expect some of these to go up marginally. But the big standout issue there is, of course, the 60% marginal rate of tax between £100,000 and £125,000 of income for the year. Now, this arises because the personal allowance gets reduced by £1 for each £2 of income between 100,000 and 125,000. So you basically lose your personal allowance by the time your income reaches 125,000. This has the mathematical effect of creating a marginal rate of tax between 100,000 and 125,000 of 60%, which is quite punitive. So if you are likely to land in that zone, then you need to give some serious consideration to how you're going to get out of it. And this can be done.
Cutting across you, sorry, very quickly. One of the practical points we see quite a bit actually is generally individuals with income around the 100,000 mark, and towards the end of the year receive maybe an expected or unexpected bonus. You know, 20,000, 10, 20,000 as such. And there's a real basic point that first off, the revenue, if you're PAYE, you may have a personal allowance included in your tax code, for example. So generally people think PAYE tax is collected at source, that's it. But of course, you go over the 100,000 mark, personal allowance is reduced, you're not entitled to that code. sorry, you're not entitled to that allowance in full. So I think the point here is you've got to be quite proactive. You're expecting income to be over 100,000, whether it's you speak to your advisor in advance, or we get a code incorrect, or we try and reduce income down via various means. Not reduce income down, but obtain reliefs via various means, which we'll come on to in a minute.
Yeah, thank you very much. That's a very good point. We frequently see people who have got a personal allowance coded into their annual coding each year, and then they end up with a bonus which takes them to an income level whereby they're not entitled to it, and they suddenly end up with a large tax bill at the end of the year, which isn't always appreciated. Anyway, just diving back into the problems of the 60% marginal rate of income tax, there are a couple of things that can be done. Pension contributions are a way to reduce yourself from 125 down to beneath 100. And more importantly, or more usefully, gift aid contributions can do that as well. And as gift aid is an allowance or a relief that can be carried back a year. So if you make a contribution prior to filing your tax return this year, you can actually carry the contribution back from 2021 back to 2019-20. So that can be a way to get yourself down to marginally under 100,000 by making a pension contribution.
Indeed, and we'll look at those in a little bit more detail as we progress through this talk, Geraint. So certainly, yeah, that 60% is a bit of a pitfall, isn't it? And as you say, with a bit of sensible planning, hopefully it can be avoided.
Indeed,
there is one other point on that is centred around child benefit as well, which is obviously below 100,000 mark, but those earning over 50 and up to I think was it 52 and over 60 and receiving child benefit, there's a potential reclaim of that. So again, it's just another small point that planning you could look at. If you know you're going to be in that banding, there's potential to split income between spouse. Maybe there's a route there to obtain child benefit. Otherwise, if you throw child benefit into the mix, the tax rate is quite scary.
Yeah,
okay,
absolutely.
All right, shall we move on then from tax bands? So next we wanted to talk about ISA allowances. Sorry, done it again. There we go.
Right, thank you. ISA allowances. As you can see, there are now 4 different types of ISA allowances that are available. There's your standard cash and stocks and shares ISA that you'll all be familiar with. That now allows you to put up to £20,000 a year in. There's no tax breaks on the way in or tax breaks on the way out, but it is fully exempt within the ISA. So that's very attractive. What people often overlook, though, is the opportunity to make contributions to their children's ISAs as well. So a junior ISA can have up to £9,000 put in it a year. If you were lucky enough to get a help to buy ISA whilst they still existed, £200 a month could go in. And of course, there's a lifetime ISA, which is really the replacement for the help to buy ISAs, of £4,000 a year. Now, any gift you effectively make to your children or grandchildren by contributing to these would be a potentially exempt transfer for inheritance tax purposes, but it does nevertheless shelter that money very tax efficiently and is quite a useful way to optimize the family's tax affairs.
I think about lifetime ISA as well, if I'm mistaken. The government top it up, I think it's 25% top up, rightly. So I know you've got to be in till 60, or it might be to buy a house. I can't remember the full details. Certainly, I think it was 60. You can't touch it till anything else. But it's quite a generous rate of return, shall we say, which you're not going to get at the moment at the banks. Let's be honest.
Absolutely. Absolutely. So worth bearing in mind, don't let your ISA allowances go to waste. There's no point in paying tax on dividends and interest when you don't need to do so.
Okay, so that's ISAs for you. Chris, I think you just want to add a few comments about the self-employed for us next.
Yeah, so just again, a few basic bits we're going to flip through now. Bits that generally people miss or seem to miss. And first, self-employment. It's always, as most will know, we have a accounting year end, and generally people don't review the year end. It's just kept under the same every year, and we do get we get the ability to change a year end. And for those that have a particular year that's not coincides with the tax year, 31st of March or 5th of April, you've got the possibility that you've got something called overlap relief. And what this does is it gives us maybe an ability to assess 2 years in one, utilise overlap relief and potentially reduce a year tax and claim tax back. It's something, again, that's quite basic, and it just needs to be kept under control if you haven't got a 5th of April or 31st of March year end as a self-employment. Secondly, we put on there, this came about actually this week following a conversation with a client who, in this current climate, is struggling for income, and he doesn't qualify for the self-employed income support scheme. And he's now at a point of saying, I've actually still got outgoings and I'm making considerable losses in the business. And it's admittedly, it's quite strange now they're not trading, but he's still got outgoings. But this particular case has. He's earned over £50,000 in the last few years, so he doesn't qualify for support. So we're trying to think what actually support can he have, and there's discretionary options he can look at from local authority. But one point we thought was actually, can we cease the trade? And what happens if we do? Of course, we've got terminal loss relief. So there's a potential there to cease the trade if he's genuinely got tax losses, carry back and claim an income tax refund there. So that was quite useful for him. And he looked at it and said, well, actually, I could do that. And going forward, I probably will have a business, but I could incorporate going forward and maybe just trade through a limited company. So there's a genuine reason for the terminal loss relief. That was quite an interesting one there.
Okay, thank you for that. So let's revisit now tax efficient investments. So over to you guys.
Yeah, with this, it's tough times in terms of rates of interest, as we know. So it's quite difficult in terms of the investment side as how we're going to benefit. So again, it's really small points, but overlooked points. First one we've said there is speak to your IFA. We do see if you've got a fund sitting somewhere, you've got an IFA advisor, your initial level of risk or understanding may be very different to now. So you may have been in an income products rather than capital growth. If you're at the stage now where your income's gone up, you might not need to take that income, and therefore you could look at a capital growth option. So just have the chat before the year end and make sure, whether it's this year or going forward, your funds are the right funds. We've said investment bonds, they're still a good option. There's essentially you take out a level of income each year, 5% I believe it is, that's tax free.
Yeah.
We're still doing. I believe it's still absolutely okay to a route to go down. That's fine.
Yeah, it is. The investment bonds are still a valid investment route. HMRC have commented in the notes to a budget a couple of years ago that they're mindful of the tax-free roll-up with offshore investment bonds, and they've got them in their eye line, so to speak, but they haven't done anything about them yet. They are also quite expensive in terms of charges and can be opaque in terms of the investments that they're actually going into. But the idea that at the moment that you can roll up the income in the offshore bond, take out 5% a year of the original investment without any tax implications, does mean you can effectively push your income tax liability down the road until a time that you've retired, if that appeals to you.
Excellent, thanks, Geraint. The other point, or the nice one on here, I think, is the 50,000 premium bonds. Again, it's usually overlooked, and it's such an easy one where individuals are getting hardly any return on that in the bank at the moment. And I quite like the risk of gambling it on a premium bond, maybe. And generally, we're told that you do. I haven't got 50,000 in the premium bonds, but we are told that people see returns on that, which is better than the 0.01% that your bank are currently offering. So £50,000 each, if you've got the money sitting there, go for it.
Indeed.
Taxable on the income.
I regarded it as being like playing the lottery each week, and you get your stake back if you lose. So it's quite attractive.
It's one that IFAs generally won't talk about, I would have thought, either, because you're moving money away from them. But apologies if there's IFAs on the line. But premium bonds is there. I'm sure you do advise the clients. And we've left in there the standard points. I'm sure most of you are aware, the EIS and the VCT. They're high risk generally. It used to be the case, dare I say, that this was more of a capital safe product, or people were pushing it as capital safe, and there was more of an opportunity. Nowadays, the revenue steered away from that slightly and put certain provisions in place, if you like, to bring it back down to where it's meant to be a bit more high risk. So you have to be careful your capital's at stake, albeit that there is relief on exit and relief on entry, together with other capital deferral reliefs. So EIS and VCTs are always there to be considered, but you've got to be the right person to go into it, really. It's not for, I'd say, everybody.
That's especially for the enterprise investment scheme. VCTs, because of their pooled nature, are of a slightly lower risk. But the EIS is certainly not for widows and orphans, I don't think.
Yeah, no, fair point. And we should have for completeness the seed EIS scheme that gives not 30% but a 50% income tax break. So you've covered half of your potential losses up front there. But no, absolutely worth considering, albeit, as you say, not without risk. So let's try and move these slides on. Apologies.
I think we'll be quick on this next one. There's not too much to say about savings accounts this time.
Oh, done it again. There you go.
I mean, look, I see it a lot. The banks, if you did have anything and they were offering any savings, the deals expire annually generally, and they don't auto renew you. So you've got to look to move the accounts. There's not much. So just bearing that in mind. Do keep an eye on online deals. I had a search before we got on, and there were some fixed terms that are at 1%, just over 1%, which is very good given the current climate. But you've got to tie your money up with them. And then just make sure it's spread. Make sure your income, you've got your 85,000 per account that you've covered yourself. I mean, I know one pluses with that for people that use our BKL Wealth service. I think they have a product that I think you put your details in once, if I remember rightly, and you can open up other accounts to move money about quite easily if you are spreading money across a number of accounts. So it's essentially kept in one place rather than you having 500 logins.
That's correct. It's a platform that gives you one set of KYC documentation, and it gives you access to a whole range of different banking deposit facilities, each with different terms, and you can move your money around accordingly to whatever suits you in terms of terms and yield. So that's quite attractive. So you can spread yourself to have 10 different blocks of 85,000 exemption.
I can tell you practically our tax guys who prepare your tax returns, it's their nightmare when you try and figure out 20, 30 different accounts, and you're missing one and two. It racks up the cost of your tax returns quite a bit. So keeping it under one roof, shall I say, is quite nice as well, and one product. We can get all the details. But of course, you haven't got any interest anyway because the banks aren't paying it. So maybe there we go.
Fair enough. Okay. We talked about gift aid before, but I don't know if you just want to quickly summarise again for us.
Yeah, I mean, the one point as well we do see is just people generally make, and maybe not so much in the last year, to be honest, is where you've got the people in the office or friends that you get the email in, I'm doing a bike ride, a charity, whatever it may be, and you do your Just Giving, your Virgin Money, and you put your 20 quid on or 50 quid on or whatever it may be, and you forget about it. And, if you're a high rate taxpayer, you're entitled to the relief. So it just makes sure that the tools against Just Giving, Virgin Money, if you've got a login, they provide your annual giving. So it's not just your standing order direct debits that you're paying. Keep an eye on those one-offs because you're entitled to the relief. And then we've got the carryback of pension, of gift aid and donations. And it's the only really the one time I'd probably say there's no benefit to preparing your tax return early, because the problem we have here, you're entitled to carry back gift aid contributions made in the current year. So, for example, the 2021 year, and if we haven't prepared your tax return now, we can put them on the 1920 tax return and claim the relief in 1920. So the real benefit was if you've got a year where you're going to be high rate and a year where you're going to be basic rate, we want to capture all the relief where it's subject to high rate. But the point is you've got to put it on the return, and if we submitted the return, we've got an issue.
If I can just weigh in there. this is a good example of where the Charities Aid Foundation accounts are of use as well, because you may want to make a charitable contribution but don't know who you're going to make it to yet. So you could make the contribution into a Charities Aid Foundation account. You can get the relief up front then make a decision further down the road as to which particular charity you wish to favour.
Yes, absolutely. And it does ensure that you get a statement every year that shows exactly all the donations that you've made. So that comes back to the point you made, Chris.
Yeah, indeed.
So there is an administration cost typically with those accounts, but it can ensure that you do claim all of your tax relief.
As we said earlier as well, the reality here is if we are in that bracket of just over £100,000, you know, yes, you'll be giving to charity, it's losing money away, but you're bringing that tax rate down. So at times, you know, some people may want to give a bit more just to get, rather than give it all to a taxman, give it a bit to charity.
Absolutely. Okay, we touched upon self-employed before. Now let's just have a quick think about employment and points to consider there.
Yeah, this is one we're trying to really go through and see from an employee point of view maybe, but also an owner-managed business, just some little bits to look at. And of course, the salary sacrifice has been around for a long time. The revenue did remove a few things for salary sacrifice. You're not left with much, but those on childcare vouchers, make sure you're making use of that where you can. Bikes will be a good one. The cycle to work scheme at the moment, we expect that will pick up a bit more, I would have thought, with people trying to avoid tubes. So going forward as an employer, you might want to offer it, and as an employee, you might want to take up on it. And of course, the bigger one with the salary sacrifice is the pensions. If we are going to make pension contributions, salary sacrifice is a good option because there's an NIC saving, of course. The relief is at source, but again, it's just it's a good way of getting that income down. It's a very efficient way of getting the income down. Some employers will pass on the saving of the NIC to the employees as well. The tax-free childcare higher income benefit charge, I mean, that's, you know, the childcare has been there. It's the vouchers, the salary sacrifice voucher scheme did close to new entrants, so it's moved to the tax-free childcare, which the revenue just gives the relief automatically online. So again, it's just making sure you're aware of that, and if you are funding childcare and able to get relief, then why not? The electric company car was one we just threw in because, again, from an employee side, we might start seeing employers offering cars rather than people getting trains and buses and whatnot into work. We may, and they may offer car parking spaces as well. And these are things that actually they are tax efficient now. Certainly the right company car is tax efficient now, and electric being one of them. And I think we're committing in this country to go in electric with the cars. Boris has said something, dare I say, a couple of months back to commit us, and it's a very low benefit in kind. So whether you're an employee that might get offered a car or a director that's able to purchase a car for them, the business receives 100% relief on the car purchase, and it's a low benefit in kind. So again, look at the Teslas, the I don't know what's out there now, the BMWs, Audis, etc. They're all coming out, aren't they? Down to Renault Zoes and whatnot. So they're a very good option. And
yeah,
finally,
sorry, Chris, I just had one caveat there. You're absolutely right about the capital allowances on electric cars and the potential for a full first-year allowance. You don't get that on second-hand cars. There's a little trap that people sometimes miss. So it has to be a new electric car that you purchase.
And that includes the demos as well. Obviously, demonstrators, I think, are classed as a second-hand cars because it's registered. They've got to be completely unregistered. So yes, very good point. The final point of note is just, again, it's a very easy one that's missed. Bupa, healthcare, relevant life cover. It might be in place, but like any insurance, it renews and they tend to bump it up quite a bit. So from an owner-managed business point of view, get them looked at. We've got guys, BKR Wealth, again, will quite happily run through your policy and just make sure you get some money knocked down this. It's not so much tax efficient, but more so just cost savings that we're trying to help with there. Just look at it, and certainly healthcare again, I would have thought is going to be on the radar for employers to offer it. So you keep an eye on that. Relevant life cover. If you've got a life insurance, look at relevant life rather than life insurance. It's tax efficient. Tax relievable on the corporate side, Tony, if I remember rightly.
Yes, most policies are.
Yeah. I think the multiples on relevant life paying out are very good. So most advisors, most IFAs will point towards relevant life cover over life insurance these days.
Okay. All right. So again, we touched upon pensions before, but this is really, this is critical, isn't it? So enlighten us, please, gentlemen.
Yeah, I mean, pensions are efficient, and I know some people don't like the pension idea still. They might be a property person rather than a pension person, but we have to look at it and say it's a good deal from the revenue ultimately. And let's look at it. We get basic rate at source. If you're using the funds to put into a bank, you're not going to get that level of money back, and that's at source. We're getting a higher rate if you're a high rate taxpayer. High rate relief if it's via salary sacrifice, it's at source effectively. If it's not, we obtain it in the tax return, and we might get money back. And of course, we've then got the personal allowance reclaim. So when you break that down, if you actually look at the net cost of a pension contribution, it's ultimately quite low with that relief, and you can get quite substantial amounts into the pension fund for a low net cost. So tax efficiencies, it's got to be looked at, and we're at that time of year where you need to speak to advisors. You've got enough time. You need to speak to somebody if you haven't made the contributions and you've got the relief. So you got your claw back. That is definitely one to consider if you're nearing the 100, 120,000. We've gone over that. The amounts that you can contribute, this is a little bit more complicated, and this is funny enough. I had a seminar invite pop up today that was literally an hour seminar on pension contributions. It's that detailed. So I'm not intending on going into that level of detail here because we'll be here for another couple of hours. But essentially, the right person, you've got 100% of your earnings up to 40,000 each year. If you are a higher earner, that 40,000 is reduced down ultimately. And don't forget, you can carry forward relief. You can't carry back contributions, but you can carry forward relief. So it gives us an option to make large contributions in the right circumstances in 1 year.
It is worth noting that because of all the bad publicity surrounding pension charges on doctors in the NHS for doing overtime, that last year HMRC did greatly improve the thresholds that the higher rate charges would kick in at. So now, as long as your total adjusted income is beneath £240,000, you can still contribute up to £40,000 a year as a pension contribution, and then it tapers down to a maximum of £4,000 a year if your adjusted income's above 312,000. But now, for a number of people who were previously only able to contribute £10,000 a year they can now contribute a lot more. So it's probably worth reviewing your pension situation.
And as we said there, the 17-18 allowance is due to be lost at the 5th of April. So again, talk to BKL, talk to your IFA about calculating your allowance if you're unsure, and maximising before the 5th of April. Certainly if it suits, if it's relevant for you guys. And then Geraint, the turning 75 point, we've got charges kicking in at 75, if I'm not mistaken.
We do indeed. And of course, going off piece slightly here, payments into pension plan is actually quite an interesting inheritance tax option as well. Because if you die before you're 75, your pension pot will go down to your beneficiaries completely tax-free, and they can draw out of it. After 75, the pot, I believe, is still free, but the withdrawals are taxed. But it does mean that you can delay taking money out of your pension and use it as an inheritance tax vehicle if your other finances so allow you to do so.
Yeah, I think it's something where I said at the start, if you're a property guy rather than pensions, I think there's enough there to say, well, actually, you should look at this. It is a viable option. You may not think there'd be much in it, and it coming out at the end there'd be not much return, but there's enough there. There's enough detail that it's worth looking at.
Indeed. Now, every year there's talk of high rate tax relief being withdrawn on pensions. I don't think there's been any more chatter on it, particularly this year, than any others. But I'm mindful we have a budget on the 3rd of March, so there is always that risk, isn't there?
They tend to deal with it, Tony, with the allowance. What you can pay in is reducing down, as Geraint alluded to earlier. With the doctors, it came about, and it ultimately got reduced down with higher income. So I think relief will be there. It's just to what extent for certain individuals.
Indeed, and of course with the budget, I mean, I believe it's slated for the 3rd of March, And to be honest, it's anybody's guess what Rishi Sunak is going to do. I mean, my crystal ball is no better than anyone else's, and there isn't a great deal of chatter in the tax world as to what he's going to do. So I suppose it's a question of, do you feel lucky, to quote Clint Eastwood? Are you going to do your planning before or after the 3rd of March?
Indeed. But that leads us on quite nicely to an area where there has been an awful lot of chatter about changes in rates, etc., and that's capital gains tax.
Yeah, so the key point with capital gains at the moment is, again, the basics that's lost, and that's the annual exemption, is that we don't see it being used enough for individuals that have capital assets. They sit and they're growing and growing, and there's some real simple points that IFAs will tell you, and it's frequently missed, and we see it, and certainly where individuals are holding shares is the first point. So the whole idea is looking at, can we utilise that annual exemption? It's nearly £25,000 for a married couple. That's quite a bit of fun. That's quite a lot of money to try and use up if we can as a release. So we look at it from a rebasing assets point of view. If we've got shares, can we get the cost of those shares rebased to a higher cost point, which means that when we do come to sell, we've got less of a capital gains tax. So it's not necessarily benefiting us right away, but it might benefit us down the line. And as Geraint alluded to, Gordon Brown put the legislation in regarding the bed and breakfast rules, and essentially you'd have to wait 30 days in theory to buy back shares. So the basic principle was that an individual would sell shares and buy them back, and you've got an inflated cost. So now we've got the 30-day rule that's sitting there, matching rules, but it's essentially waiting 30 days, and of course the price may move, and you've got a little bit of risk. Now there's quite a lot of options around this, which are really neat actually. I think when you look at it, so it's around the bed and breakfast theme, and the first one being bed and ISA, which is simply selling and buying back in your ISA. Make use of your exemptions. It doesn't have to be a whole holding particularly, just an amount equal to the annual exemption. So you've got it in the wrapper, you're caught, and it's nice. It's tax free if you do come to sell going forward. Bed and SIP, simple as sell it. If you've got the option to buy it in the SIP, do so. There are restrictions of what the SIP can purchase, so it's not always as simple, but it's an option that's there. Again, very, very straightforward one. I'm surprised this is there. Bed and spouse, sell it. Spouse buys it next day, same day. You've got your uplift. I mean, that's a very simple one. I'm amazed it's still been about. There's easy way to make use of your exemptions, and of course the final being bed and something similar. And this is very much a sell your Coca-Cola shares and buy your Pepsi. I know it's sell your Apple and buy your Tesla kind of thing, or dare I say a similar fund. Sell a tracker fund in whoever's offering it and buy another similar one back. They'll generally be the same. So it's giving you that opportunity just to make small changes before a year end. And of course, if you're doing this just before April, dare I say you could equally double up and do it just after April and get it. You've done your movement, a couple of movements in a space of a couple of days, and utilise nearly £50,000 of potential release. The one caveat I would say with that is, do bear in mind if something comes up going forward in that year and you desperately need to sell something, you've lost an annual exemption maybe. So do be a little bit careful with being that early on in the year. Maybe it's a little bit more towards the end of a year. Generally, you see that those people that have funds, those people that have brokers and looking at this, managed funds, is they tend to do this anyway. But ask the question, because some let it slip and some think they haven't got the instruction to do it, so they might not move the money about. They may not make use of ISA allowances. They may not bed and spouse.
Understood. Okay, so that's again, it's just sensible, pragmatic tax planning that, as long as we are mindful of the existing anti-avoidance, should not be subject to any HMRC ire. We also need to talk about tax rates, and this is where, as we say, we don't know anything more than anyone else, unfortunately, but there is significant chatter about the possibility of rates being increased, perhaps aligned with income tax rates. We simply don't know. We'll have to await the budget. But do you want to just talk us through what the rates are at the moment?
I think it's exactly that, Tony, that the crystal ball, we haven't got any better crystal ball than anybody else, and I wouldn't like to say what's going to happen. But the reality of what we have at the moment, are capital gains rates are lower than income tax rates, and it's the question is, do you want to liquidate? Do you want to sell something up and make use of the rates if possible? Certainly, as a basic point, we see, don't forget the spousal transfers at no gain, no loss. We can't unravel it after it's sold, but before you sell, if we can make use of basic rate bands of a spouse if they've got it, annual exemptions of a spouse if they've got it there, then a very straightforward transfer to spouse and selling at that point, or selling after the transfer's done, can make use there. And don't forget, we've said it before with pension contributions, it does give you an extension to a basic rate band, which does apply on CGT as well. So we can make use of a 10% band potentially if we've made pension contributions and don't have other income, and we've got basic rate band remaining. And it's a very simple one. So from a planning point, if you're going to sell, sometimes making a pension contribution and getting the relief in the pension fund as well as obtaining capital gains relief is quite attractive and easily missed.
Indeed. So those are CGT rates. I think the usual caveats, there's a host of anti-avoidance to stop you trying to convert what would otherwise be an income game into capital, etc., etc. So do seek advice if you're considering anything more complicated or potentially aggressive, and we'll be happy to let you know where the revenue's red lines are. A lot of this is going to do with property though, isn't it? And there's plenty to consider there pre-year end.
Yeah, we've seen some nice things with property recently. Some of this is fairly vanilla, but the buy-to-let borrowing side, we know that high rate relief is being lost on buy-to-let borrowing, but there is still basic rate relief available, even if you're the high rate taxpayer and you're fortunate to have to buy-to-let properties. And we still do see mortgages on own home and no borrowing on buy-to-let. There seemed to be a reaction a couple of years back when people think the interest relief is being lost on buy-to-lets, and it's not. You've still got the basic rate. So the idea is, if you've got the opportunity and it works, and you find out from the mortgage deal it's appropriate to do, you can move from your main residence and remortgage on the buy-to-let and obtain basic rate relief. Very, very simple to do. You've got to be careful on the amount, because you're restricted to the purchase price of the property, if I remember rightly. So you can't just remortgage of the entire amount if it's greater than the value of the buy-to-lets, but it gives you some relief. The spousal transfers, we've alluded to a few times. Rental property, if you've got the option or ability to do a spousal transfer, there's a couple of caveats here. I think if you've got a property in a sole name and it is mortgaged, be very mindful, because creating and transferring an interest to a spouse where you've got a mortgage in a sole name, not all lenders like that, especially if you haven't told them about it, so you've got to be mindful there. It can create an SDLT issue at the same point, so you've got to be careful. But if you do own it jointly, the default position is a jointly let property. If you own it jointly, is 50-50. Now, what we do have the ability to maybe move that, shift it from 50-50 if it's genuinely not. So potentially we might be moving more income to a spouse, which we'll come on to on a worked example. The other point I've noted down here is hopefully most people will be aware is the reporting issue to HMRC. This changed April 2020, and essentially it means that you have 30 days to report a disposal on a residential property to HMRC. And we are seeing this being missed. It's quite frequent it's being missed, and typical HMRC, it's not easy to report either. So don't forget it's there. Don't leave it to day 28 to do reporting, and I'd say don't rely on the conveyancing solicitor to advise you on this. They disown responsibility. So you've got to make sure, if you are thinking of selling, it's not just reportable on the tax return. It is to be reported on a separate means. Geraint, I can see him jump in.
Yeah, it's probably worth pointing out that the change in the rules on the CGT reporting in April 2020 was for UK residents selling. There's already been a CGT reporting for non-residents selling, going right the way back to, I think, 2015, I think it was.
Yeah.
So it's now even someone casually selling a rental property whose UK resident now has to do a report within 30 days.
And pay the tax, actually, is one thing I've left off as well, and pay the
Yes.
liability. Don't forget that.
And I don't know how many lawyers there are, and how many conveyancing lawyers there are listening to this, but I have asked conveyancing lawyers whether they regard themselves as having any professional obligation to inform the vendors that they need to consider whether or not a capital gains tax report needs to be made. And I've had several shrugs of the shoulders as a response. So don't assume the conveyancing lawyer will flag this to the vendor. I'm not convinced they always do.
Yeah. The other point on here, I like this point at the moment, is equity release. Now, I can't give the investment advice, so I'll try and keep it to the tax reasons for equity release. And I'll give an example, actually, that we've seen recently, and that's an individual with a family home, London, about 1.5 million, no mortgage, husband, wife with children and grandchildren, young grandchildren, and limited pension. We're not talking about substantial pension at all. And that's it, just carrying on, didn't think anything of it. Children are trying to buy a property, can't do in London. Now, they've got the option, they could maybe remortgage and get some funds and maybe give to children. That's a possibility. But equity release is there now, and it's regulated. It has a tarnished name, I think, going back, but now it's regulated. It's a little bit safe. Well, it's certainly safer than it was. And what we have is the ability to just release some of that equity out of the property. Maybe in this case, let's say out of a 1.5 million property, maybe £300,000. That's creating a debt on the property. So from an inheritance tax viewpoint, that's a debt, which is great, reduces our IHT exposure. But of course, we've got the cash that's there, £300,000. So what we're going to do with it, we've got 2 children, and we're going to give them £150,000 each to get on the property ladder. We survived 7 years; it's out of our estate, and we've got a debt we've got a debt to the estate. And we've got no IHT all of a sudden because we're down to £1 million. So yeah, it's a nice option in the right circumstances. This really fits. We're seeing it crop up more and more now because there's good deals that are being offered, low interest. You only repay equity release upon two instances, and that's death or you sell the property. Interest can roll up, so you're not funding it like a mortgage. It sits and it rolls up, and generally at low rates. Garrett.
There's an additional side to this as well, which is that if by doing the equity release you reduce the estate down to beneath 2 million, then the transferable main residence band can come into play as well.
Yeah.
So you're going to get an additional allowance by doing it. Yeah. So in the right circumstances for the right people, it can be the right thing to do.
I think we've seen it for people concerned about going into care homes as well, and asset protection, if I remember rightly. So the worry that they'll end up in a care home and want to get a charge on the property, so care home don't take all the money. Of course, you can raise some funds, give it away, and there's a charge sitting on that property, so care home can't take everything. But there's little bits and pieces there. But so it's not always tax. Generally, personal tax, capital gains tax, or other aspects that we look at. The other bits on here, stamp duty, land tax, whether the rates are going to, or whether the reduced rates are going to get extended. Again, don't know, crystal ball. People are hoping, because at the moment I'm being told that searches are taking a hell of a lot of time to happen. They're delayed like everything else. So how many deals are going to get through before March, end of March? We don't know, so it might get extended. But at the moment we haven't seen anything on this. So we don't know. And finally, quite an interesting one is the incorporate a property company. So you are sitting there in the right circumstances, getting property into a company is an option. It's not an easy option in all cases, because we do have to consider capital gains tax, we have to consider stamp duty, land tax as well. But there are ways in the right circumstance to make that happen. So it is an option that's out there. And of course, the benefit of then having the property in the company, we have lower tax rate in the company ultimately. But if we're going to, well, depending on what we're going to do, I won't go into greater detail on that, but there are options on it.
Yeah, agreed. It's a complex area, isn't it? And something we'd be happy to advise on. Time marches on, so why don't we just touch upon IHT and gift allowances, and then we've got a couple of
I've been quite
examples to
quick
talk
on
through?
this one, Tony. I mean, this is again making use of allowances, and it's for IHT purposes, so it's not necessarily for everybody in the right position because you're giving money away. It's not yours, not going to be yours. You give it away, but they're just basic allowances that if you are giving, you do it correctly. I guess 2 points on there that I think are quite interesting. The gifts out of excess income is always one. We frequently see school fees being funded. And potentially it's a pet, so it could come back into charge. But if we've got the option where we've got excess income, so that means individual is receiving income, take out all of their living expenses, we're talking shopping, petrol, any debts, etc. And if we've got an excess income there, we can give that away regularly and it instantly falls out of IHT. So that's as of the day of the gift, and that's quite attractive if with certain things such as school fees that may be paid regularly, so quarterly or term based. We need to make sure it's done correctly, so you need to document, and the revenue would like to see the fact that you've calculated that there's excess income. But again, it's a good one for an IHT. The other one I put on there that I really like, and it's quite a surprise, you don't see it so much, people doing this, but giving into a grandchild's pension. Grandparents still alive and they want to go into, we alluded to it earlier on, putting into a pension. You put 2,880 in, it's grossed up to 3,600. Obviously the grandchild can't touch that, but if you are in the fortunate position to be able to make gifts to grandchildren, it's quite a nice way of getting them on, and do that at birth up to the age of 18 and start a present, say there you go at 18, carry on this pension. It's a nice bit of relief that you're not going to get at the bank. Geraint, sorry, you want to jump in?
I was just going to jump in on something you were saying a bit earlier about the excess or expenditure out of excess income. When we fill out IHT forms for probate purposes, there is actually an income and expenditure account embedded into the forms if you wish to claim that. That'll show what your income was, what the tax you paid was, and the various expenses that you would naturally incur in terms of food, holidays, clothing, things like that. Now, it's often very difficult for the executors of the estate to be able to work all this out retrospectively, and to trawl through bank accounts to try to work out what was and wasn't a reasonable gift to be made. So it's probably worthwhile that if you are of an age where this could be important, that you do keep a rough record that you might update once a year, showing what your income is, the gifts you've made, your rough expenditure. So whoever's going to be dealing with your estate once you pass away is in a good position to be able to maximise all the allowances available.
Yeah, good point. Good point.
Okay, right. Shall we, gentlemen, try and pull all this together into an example? So while you guys pause for breath for a second, why don't I just run through Mr. Rona. He's 58. He's self-employed. He's got income £145,000 per annum. Very nice. Been married for 35 years to Mrs. Rona. Now, she looks after the grandchildren, but does occasionally assist Mr. Rona with business admin tasks. They've got substantial savings, about 100 grand. And Mr. Rona generates about £1 grand of interest on that per annum. He's a shared investment portfolio worth around £100,000, and from that they get 4k of dividends each year. They jointly let a property. It's worth about £300,000. It's no mortgage, and they get 10k of rental income a year. Their home is worth £1 million. And Mr. Rona wants to retire in a couple of years at 60. Good for him. He's a small pension pot, but he hasn't made contributions for a number of years. Shame on him. So what can we do for someone like that? We've, I think, broken it down into, let's start with sort of income and CGT planning ideas, gentlemen. You have 1 minute. The clock starts now.
First off, I mean, ultimately, you're looking at whether allowances are being utilised up, aren't you, across husband and wife, and whether we can look at moving particular assets. I would caveat there, essentially, he is married 35 years, so one would maybe say that's quite a safe marriage. There is always a little bit of risk if we start transferring between, but yeah, I think that's the flavour we're getting at here, is we're saying okay, we've got some savings there that's generating £1,000 of interest a year. That's being taxed. He's additional rate taxpayer, Mr. Owner, therefore he's paying tax on that £1,000. If that's going to Mrs. at the moment, it looks like she has income of about £5,000, which arises from a joint property. We've got a personal allowance that's being wasted. We've got savings rates that are being wasted there.
It's a dividend allowance being wasted,
dividend
isn't
allowance
it?
being wasted. So it's looking and saying, well, actually, can we transfer maybe some of the shares, put the shares in joint names? They don't need to be in her name because there's be 2,000 each. He would still be entitled to. The banding. So ultimately, it's making use of the bands. I think we've got there, Tony.
Okay, and what about from an IHT perspective, gentlemen?
What have we got? The value of estates 1.5 million. I think, as we've alluded to, pets previously. Maybe we know we've got children and grandchildren. Maybe we want to look at equity release if they can afford it. One might suggest they can with the savings that's there. What do we want to look at? Gifts out of excess income. Possibly got some.
Absolutely. Maybe they can start gifting down to the children. £3,000 a year each can go down without any IHT impact at all. Yeah. And you know, on marriage, there's additional gifts that can be made. I think it's £5,000 to children on marriage, £2,500 to grandchildren. Is it 1,000 to friends and other family? Yeah. Are all IHT exempt?
What about BPR? Looking at this, we might look at. They've got a portfolio there. We might look at getting that into AIM Holdings. It's currently qualifies for BPR. Might be a good one.
Yes, I think it's
going back a step quickly, Tony. I just realised equally we've got Mrs. who does do some duties there for Mr. Business admin tasks. We might want to look at whether we can pay a salary, or dare I say, we might want to look at a partnership maybe. If it's an option. We've got a basic rate band of Mrs. there that we might want to use up.
Yes, absolutely.
It's a good question, Mark, over business admin tasks, how much he's actually doing. It's something you've always got to look at. The revenue would look at that quite closely. But if she's genuinely contributing, we can pay her a salary, couldn't we?
Indeed. Mr. and Mrs. Rona, they jointly own the let property. One could consider whether Mr. should gift his share completely to Mrs. and she takes all the rental income.
Yeah.
A question of blending all this stuff together.
I think this is very vanilla. This is very standard points, but it's easily gone, and we're not talking about really small savings here. This could be quite substantial savings. I mean, the pension point there, making a substantial pension contribution, looks like he could afford to do it out of existing savings or out of income, and there's going to be quite a bit of tax relief available there.
Yeah.
Yes.
So this is a vanilla case, but largest numbers.
And he'd get his 25% lump sum out from the pension fund.
Yeah,
as well.
He's looking at 58, so he wants to go at 60. So like you say, any contribution going in, we're then going to take 25% back out in 2 years as he's got it, tax-free. With pension payment.
Yeah, one other point I just add, we talked about moving the interest in the let property. Now, although absolutely, there's an exemption from CGT on transfers into spouses. There's no exemption for SDLT purposes. Now, this is mortgage free, so there'd be no assumption of debt here, so that's fine. But people do need to be careful if you start moving property interest between spouses and there's any assumption of debt. That is consideration for SDLT purposes. And okay, you've got the SDLT nil ban, but if you're not too careful, you might trigger an unexpected liability there. So
it's one you can't jump into and do. Just get the advice on it, but it is an option. There are options there. It may be the case that you pay the debt down and then remortgage, but look, there's bits that are there.
Okay. All right. Thank you for that,
Wills, Tony.
Absolutely. Now, as I said, we will circulate these slides afterwards, so I think we did cover off all of these points in our little chat there. So we've set out there the income and CGT ideas. There's the IHT ideas that I think we covered in particular. I think the BPR one is very, very important and shouldn't be overlooked there. To end with, and sadly something that's often overlooked, but I think particularly pertinent in the current climate, wills are important. Geraint, do you want to bring us home on this?
Absolutely. Time is moving on. My digital clock tells me it is 1:59 at the moment. so I'll rattle through this as quickly as I can. Yes, you do really need to make a will. If you don't make a will, then when you die, your estate will be divided according to the laws of intestacy, which may not always mean that who you want to get the money will get the money. And it can also mean that it'll be distributed in quite a tax inefficient way in some circumstances, especially where children are concerned. And if you're going to want to try and do a deed of variation to vary the intestate position where children are involved, that could become very difficult because of the protection that the state would afford to them. So yes, definitely do it. It's a good opportunity to also name children's guardians. You'd need a backstop charity in case everybody goes down in a plane together at some point. You may need
the basic point on this, Garrett, isn't it? Is if you've got children, you're over 18, etc. There's no reason not to get a will. You really should. Is the point.
Oh, absolutely.
It's just get it in place. This is we can talk all day reasons why, but ultimately it's very simplistic. You need to get the will there.
Indeed, and we can arrange it for you. We do wills, and we can tie in the inheritance tax planning to the exercise as well. It's always useful having the people doing the will who actually did the inheritance tax planning, because at least they know what needs to go into the will.
And arguably LPAs, you say more important, as important wills?
Yeah, just as important. In fact,
so
one of my colleagues I know failed to get an LPA in place before his one of his parents lost capacity, and the trouble he had doing it retrospectively took, I think, 2 years to get the courts to execute an LPA done retrospectively. So get it done while the person's still of sound mind.
I've had this seen this, Garrett, in a younger capacity as well. So you may think this is something you do in your 50s, 60s, 70s, but I've seen people in their 30s have strokes and they don't have capacity, and there's been no LPA, and they've been a good earner, and it's been quite distressful for the family because they haven't been able to do anything. It's had to go through the courts, and it takes time. The LPA doesn't take time to do. We can get that done still. So it's just a basic point. Coming away from here, if you haven't taken anything else from any of the tax planning points and they're not relevant, I'd say please go out there and get an LPA and a will, and we can obviously help with that.
Yeah, absolutely. And it doesn't need to be a stroke. It could be a car accident. It could be almost anything.
Yeah.
So yeah, please do that.
Okay. Right, thank you for that, gentlemen. So that brings us pretty much to a conclusion. As we say, nothing. Go on, please do.
Sorry, I've just seen a couple of questions. There's been a couple of things come up on Bitcoin that we haven't touched upon. I'm not going to touch upon it now, but I would say please get in touch with myself and Garrett separately, because we're frequently dealing with cryptocurrencies these days. There are separate rules on crypto, so I think get in touch separately for those that have asked questions on Bitcoin and crypto.
Indeed. However, I would make one caveat, because I can see the questions as well, and that is we can't give investment advice.
No.
So what our opinion on Bitcoin as an investment is A, irrelevant, and B, we can't tell you even if we knew. So we're happy to talk about the tax implications, obviously.
Absolutely. Thank you for that. So just to summarize, this is all about sensible, pragmatic tax planning, but it can be very, very important. And now is the time to consider it pre-year end. Are all your allowances being used? Are you making use of the various tax breaks that are out there, such as in particular ISAs, pension contributions? If you're in a civil partnership or a marriage, are you spreading income and capital assets across that marriage so as to ensure one of you isn't incurring tax at a higher rate than the other? Do maintain records and documents for your capital assets that may be needed. And it is important, even if you still feel like Geraint and I, that you're still young. We ain't that young anymore. Iht planning, gift allowances, it's all important. And I think we've made the point about wills and LPAs. And if you can get ahead, get your tax return done early, not just for good housekeeping, everything's fresh, but if you get it done by 31 July, then that does help as far as payments on account goes, etc., etc. So that brings us to the end. Thank you all very much for joining us. As I say, we will circulate the slides and a copy of the presentation, so you can share that with colleagues if they've missed it. We hope you found this useful. Apologies, I know we haven't had a chance to answer all of the questions. We will try and come back to you, be it personally or if they're of general interest. We'll tag those on when we send the links. So in the meantime, do please all take care, be well. And if there's anything further we can do to help you on any of these points or on tax matters generally, there are contact details, and we do look forward to hearing from you in due course. So we'll be back before too long. Not sure what we're going to cover next, but hopefully we look forward to you joining us again shortly. And as I say, for now, do take care. Bye now.
Thank you all.